Time now for the word on Wall Street. Top investors watching your money. Joining me now is former Gartman letter editor and University of Akron Endowment Fund chairman Dennis Gartman. Also with me here on set, Rebecca Walser. Dennis, let's start with you here. Futures this morning, we are seeing some red arrows again. I don't think that we're at this point too worried about it. It's only the first week of the year. But the 10-year, that is actually moving ahead of the December jobs report. And that's really the big data point we're going to get today at 8:30. So economists are looking for 170,000 non-farm payroll jobs to be added, the rate rising to 3.8%. Dennis, what are your expectations for today?
A long time ago, I quit forecasting the non-farm payrolls number because when I found out that the average revision from one month to the next was 35, 40, 50%, you could put out a number and appear to be quite foolish when the number came out, and a month later you proved to be quite correct. So the consensus is that we're going to get 175 to 185,000 jobs added last month. Time shall tell whether we get that or not. Yes, we will indeed see the unemployment rate rise a bit. We got a little extreme on last month's number. And always remember that the birth-death number, the birth-death revisions to the non-farm payrolls can be quite large. We've seen as much as 500,000 jobs added by the birth-death number. In December, we added 31,000. So I think I'll just go with the consensus, 175 to 185,000. I think the Fed will take a deep breath on that number and do absolutely nothing. I think the market has anticipated far too many rate cuts coming in the coming year, and I think it'll be a long time before we actually see the Fed change monetary policy and begin to move the Fed funds number lower.
Okay, Rebecca, pick that up because, if you look at the dot plot, the Fed's saying 3 rate cuts in 2024. The markets are looking for more like 6 rate cuts in 2024. The problem with that is that if you have 6 rate cuts next year, that means something is really wrong with the economy. Yeah. And that's also going to be a market negative. So which is it?
Yeah. Cheryl, we have never been here before, ever. This is uncharted territory since 2020 when we printed so much money globally. I looked at the Federal Reserve's balance sheet. We were under $1 trillion and at $1 trillion forever, modern times, obviously. And then we went to $2 trillion in 2008. We stayed at $2 trillion for a while. Then we went to $4 trillion. And then 2020 came and we doubled again at $8 trillion. Now we've been maintaining that level. And here's the problem, Cheryl. Uncharted to have a balance sheet that high, it really handicaps the Fed's ability to do something if we come into some massive economic problem, depression, whatever happens, geopolitical threat, whatever happens, this market takes a downward spike. How is the Fed going to fix it this time? The market is already pricing in 6 rate cuts when they're saying only 3. This is a problem. And for everyone to say soft landing, it's here, it's delusional. It is irrational exuberance. That's what it is.
Yeah, and you say it's delusional. And that soft landing is going to be, well, we'll see what happens. Dennis, back to you then. Let's talk about the markets in general. As here we are in 2024, and the markets did so well in 2023. There's a lot of concern, a lot of discourse about the tech sector and whether or not it's going to be another year of AI that's going to drive the market, or is it going to be the Magnificent Seven? Or are we going to be looking for more of like a value growth story, more of a value story, for 2024? What's your predictions? Again, I'm asking you for predictions.
If I had to choose if I have to be a buyer, which I don't want to be a buyer at this point, I think we are delusionally too high in the stock market. But if I have to be a buyer, I'd rather go with the value rather than high tech, just because we have become so egregiously extended to the upside. I am reminded too much of what happened in late 21, early 22, when we reached a high of the market in the first day of 22, and from then on went straight down. So I would tell people be very careful. Owning a lot of stock at this point, I think, would be an ill-advised decision. And as the chairman of the University of Akron's endowment, I've actually had us get a little bit less involved in the stock market and a little more involved in the gold market, a little less involved in the long end of the bond market and shortening duration. I think we're having a recession. So I'm just going to tell people, be very careful.
You do think a recession is still on the table. That's interesting, Dennis, because the Fed at least did tell us that they believe that they're done with rate hikes. But Rebecca, weigh into that. But it is an election year. To Dennis's point, if it's a value story, a lot of these companies, if they can introduce and implement AI into their businesses, you could see whether it's a PepsiCo or a Coca-Cola, whoever, take your pick, those stocks could actually benefit from some of the commentary I've seen.
You're going to have to get value that actually adds without a lot of costs, Cheryl. So AI would be exactly that formula that you could get profit margin swings to the upside without a lot of, I'm not saying it's cheap, but it's cheaper than property, plant, equipment expansion, new employees, all of those things traditionally. So AI could be the way, but this is just so many headwinds. And I just want investors to really understand where we are globally, where we are in the United States with an election year, with potentially already 2 geopolitical risks, Maersk not shipping through the Red Sea, the United States military over there shooting at ships. People, this is a crazy year, plus an election, 2 cases going to the Supreme Court already that will be heard, they will have a weigh-in. This is a banana republic situation. We've got states taking off potentially actual presidential candidates before they've even been charged and certainly not been convicted. This is a crazy year, and that means the market's probably going to be crazy.
Well, you know what, Dennis? I'll give you a final word because you know what? It's not going to be boring.
It's not going to be boring. It's going to be extremely exciting this year. And my fear is that it'll be exciting to the downside, not exciting to the upside. So that's my story, and I'm sticking with it.
All right, Dennis, we're going to let you stick with that story. It's always good to see you. Dennis Gartman.
Good to see you, Cheryl. Thank you.
Happy New Year, Dennis. All right, Rebecca's.
Here we go, Cheryl.
Right, taking a look. All right, well, we're already ready to go here. Here are futures for you. Dow down 107. NASDAQ is down 50. S&P is down 13 in the pre-market. Let's pull up the 10-year Treasury yield. We are now a little over 15 minutes away from the December jobs report. So here are the expectations. 170,000 non-farm payroll jobs expected to be added to the economy, and that did tick up a little bit overnight. The unemployment rate expected to rise to 3.8%. Let's bring in Making Money with Charles Payne, host and author of Unbreakable Investor, the man, the myth, the legend. Charles Payne is here on set. So, we were just talking in the break about the revisions and how we keep getting a revision every single month. So you're expecting.
And revisions are natural, but the revisions are always the actual number was a lot lower. And it's one thing to say, listen, everyone's losing faith in government data. For instance, the JOLTS report, the survey, only 30% of respondents even fill out the form anymore. That's happening across the board with all of these things. That's why there's some talk about maybe the household part of this number being more legitimate than the establishment part. Be that as it may, though, this falls on Wall Street, right? These are analysts. This is what you do. Okay, we're not saying you're going to be right, but why did you miss every single month, shattering the record? What the heck was up? Was the fix in or not? And, honestly, was the fix in or not? And, and then, of course, the way it's articulated. So we expect 110,000 jobs. We got 120. It was a robust number. It was strong. It was amazing. It was driving me nuts. It just drove me nuts every month last year because, half the jobs were leisure and hospitality. The other half were government jobs. And then the more important parts of it. It's a 25-page report. There's some nuance to this thing that's really, really important. But it's interesting. You were bringing up before this the yields now, because this 4% is the key. For that 10-year,
we're
right?
just underneath it,
We're just underneath it. One of the hot things on the street right now, and I sent it to your producers, but I sent it late. There's a big bet someone put down on the yields moving today. It's an options bet.
Up or down?
Spiking.
Okay.
$600,000 bet. If the yield spiked this morning to a certain point, they'll make $10 million. And when you see something like that,
we're at 4%.
Right. But they spike around let's say 4.15, 4.16. The person who made this bet will make $10 million. And it's interesting because you always say, that's a really good. I'm looking for the right word without being censored here, right? It's a hell of a bet. So.
Just be yourself.
All right. Conversely, though, you have to also say, why did Jay Powell take that victory lap?
Yeah.
He didn't have to.
Right.
What was it, and why all of a sudden a sense of urgency from the Fed? You always believe that the Fed has insights that none of us have. You want to believe. I mean, listen, they've got, first of all, they got all the PhDs, but no, they have all this access to all this information coming down the pike. You got to wonder. And the last main thing that was standing was the jobs report, which is a late cycle indicator anyway. So it's going to be interesting to see what happens here. The other things I think that are intriguing, we just had up on the screen wages, right? So job leavers are now getting far less money than job stayers. All of them are coming down. Participation obviously is going to be really, really important. And also, if we take out, and I think we've got this chart too, let's say we were to take out the jobs number, if you take out healthcare, government, and leisure and hospitality, the job number has been flat since August. We haven't created any new jobs in this country. We haven't netted any new jobs. And all of those jobs, for the most part, are either powered by government spending or, in the case of leisure and hospitality, the lowest paying jobs out there.
I'm so glad you brought that up, because there was a deep dive into the job numbers at the beginning of the week by the Wall Street Journal at the editorial section, and it looked at where the jobs are being created. Guess where they're being created? Government, social services, and healthcare. Yeah. What does that tell you? It is government spending on migrants, government spending on welfare, government spending on homeless. I mean, that is where the money is going,
right.
Or, where our money is going. So these really aren't quality jobs, the types of jobs that you want to see that would actually boost the economy.
It's not organic. It's not organic growth that we really, really need, to your point, to have true or organic prosperity.
Yeah, I mean, also, too, really good. I do want to look at mortgage rates really quick, because you brought up Powell, and I want to get your take on this with Jerome Powell, because the 30-year actually ticked higher for the first time. It's been down for a while. Now we're at 6.62%. Obviously, the housing market is something that is near and dear to my heart, but the Journal says a key factor that's pulling these rates down has been Treasury yields, how that extra differential has been shrinking for 8 straight weeks.
Right.
So it's an interesting dynamic here.
1/6 of the difference is because of the yield, the spread on the yields between the. But, I think one of the things that we learned last year is that Powell and the Fed only have so much control over yields in the first place, right?
True.
I mean, look at all the things that started influencing it. Even as not as equal but close, our spending. These auctions. Remember, this rally actually began. The market actually rallied. We bottomed on October 26th, but I think the rally picked up speed when Janet Yellen, the Treasury Department, put out their schedule of their auctions, and they shifted off of the notes and bonds and more to T-bills, because the onus is, if you can't get a buyer for these bonds, you have to hike up the yield. So if the Fed's not buying, if Japan's not buying, if China's not buying, and it's just really professional investors who are buying, they're going to drive a hard bargain. That means yields will go up. So for her to circumvent that and still fund this big government spending, they put more onus on these Treasury bills. Now, here's the problem with that. These bills have to be paid quickly, right? They're bills. They're short-term lending. That means the taxpayers paying all this money over and over again instead of borrowing money long-term. So the whole thing got screwed up to the point where the Fed doesn't have nearly the control that it once had over yields in the first place.
That's interesting. Well, obviously, we've got 12 minutes to go now, 11 minutes to go until we get these numbers. You're going to be with us for the job.
I'm ready. I'm buckled up. They did promise me a drink, but I'm
non-alcoholic, of course. But, yeah. So you're going to stay with us for the rest of the hour. Obviously, our jobs panel is going to be joining us after a quick commercial break. Take a look at futures this morning as we are now minutes away from the December jobs report. Economists are expecting 170,000 non-farm payroll jobs to be added to the economy. The unemployment rate expected to rise to 3.8%. Joining me now is ZipRecruiter chief economist Julia Pollack. Heritage Foundation economist and former Trump economic advisor Steve Moore. Navalier & Associates founder and chief investment officer Louis Navalier. Manpower Group chief commercial officer Becky Frankowitz. Also with me here on set, Charles Payne and Rebecca Walser. It's so great to have all of you with me today. And Steve, I want to start with you because you have been with us every month. Charles was talking about those revisions. We've had them every month. Give us your expectations as we await the jobs report.
Yeah, Charles is spot on. I mean, these numbers are just like a yo-yo going up and down and all over the place. You have two different surveys, the survey of households, the survey of establishments. They've been divergent. I think we're going to I would bet on the under on that 180,000 job number, partly because the household number last month was lower than the other one. By the way, there's also a sign of a slight slowdown in the economy, and you've seen more layoffs announced in the last month.
Yeah, well, it's interesting, too, Julia, because we were talking about the types of jobs that were out there. And, we were saying it's government jobs, it's healthcare, it's social services, Julia. But at the same time, we're seeing many Americans that are taking a second and a third job. And I'm wondering if that is going to be reflected again in these numbers at 8:30.
That'll be an interesting number to watch. As for the point about job breadth, the economy has seen job growth narrow substantially. Over the past 6 months, 99% of the gains were just in 3 major sectors. And outside of those sectors, the labor market is looking pretty anemic. And so we may actually find that the number of multiple job holders does not rise because people aren't finding opportunities to pick up secondary jobs.
Yeah, well, and Lewis, obviously, investment decisions are being made. Charles mentioned a $10 million bet, on yields. But again, the investment decisions can be made on the data that we get. How do you play it?
Well, obviously, yeah, some big institutional investors betting that the number's going to be stronger than expected because they're betting that Treasury yields are going to go up to 4.15 today on the 10-year. So I don't know if there's a leak or this person's just smarter than everybody else. But yeah, strong job report's going to put upward pressure on interest rates. And the rising rates are one of the reasons that the market's been in a grumpy mood this year.
Charles, talk about that. Add to what he's saying there.
Well, listen, the yields, it's been the Fed that's moved bond market. The bond market has moved the stock market. That's been the equation for a long time now. And I mean, honestly, this is the first time in my career when I wake up, the first thing I'm looking at are bond yields, right? Like nothing else. I don't care about anything else. It's bond yields, bond yields, bond yields. They've come down fast. They were at 5. That was a really scary moment. It's okay that there's some equilibrium here. I do think the markets will be really worried, though, the equity markets, if we were over 4% after this report. So we're going to get instant reaction. Now, a lot of the time that's knee-jerk, and things can change as the narrative changes throughout the session. But it's going to be so critical to watch what these yields do as soon as this number comes out.
Yeah, no. How about Rebecca? What are you looking for when these numbers cross?
Sure. I was looking back at last year because everyone's comparing 2023 to 2024, and are we going to see, the same kind of market we had last past year that was up to the surprise? And if you look at January of last year, there's 517,000 jobs. February, 311,000. March, 236,000. That's 1.1, just under 1.1 million jobs created in Q1 of 2023. And we're talking about 167, 170,000. In other words, completely different situation. And that's with the expectation of being high. We've had all these BLS revisions every single month for 13 months. People don't even trust this number anymore. So I think that what I'm trying to say is even if the number is a good number and it does push yields up, I think that we're seeing slowing wage growth. And I do agree that it's so sector concentrated that it's not organic and it's not going to actually deliver what this market needs to keep having a great year.
I want to pick up on that wage story with you, Becky, because and your perspective from Manpower, because speaking of those average hourly earnings month to month and year to year, 3.9% is the average jump year over year. That's wage inflation, and then the month to month we're looking for another jump of 0.3%. So that tells you that there's still going to be inflationary pressure on companies that are hiring. Are you seeing that in your research and in your business?
Yeah, so first I would say, Cheryl, many Americans are choosing their word of the year for 2024. And if the labor market chose its word of the year, it would be balance. So we are seeing equilibrium come back into the labor force. We're seeing moderation in terms of the rate of hiring for sure. We saw that in our real-time data from summer. And to your point, we're seeing stabilization of wages, but we are still, as employers, rewarding job switchers versus job stayers. The rate has come down. If you change jobs, you get about an 8% increase in your pay. That was up 15% at the beginning of 2023, so we're seeing that moderate. We are seeing moderation, but still, we're able to hold on to talent, and we're rewarding those who change jobs.
Julia, are you seeing that same type of pattern?
Yes, well, wage growth has slowed a lot over the course of the year from around 4.8% to 3.9%, but inflation has slowed more. And so workers have seen their real wage growth flip positive, and that's a good news for workers, and it's the reason that consumer spending has been so much higher than expected.
I don't know, Lewis. I mean, the consumer spending component, there's been so much debate about whether the consumer is strong, whether they're weak, whether they're going to keep spending, because we see personal savings rates. Those are going down. We're seeing credit card use is now jumping exponentially. We'll start to get bank earnings. That's going to paint that picture for us. But that's an economic story, Steve. Weigh in here.
Well, look, you guys made a key point earlier, which is the sector of the economy that has grown the fastest in terms of employment over the last year has been government. And so that's when we report those numbers in a few minutes, please tell us what that government employment number is, because, we want to see the government shrinking and private sector employment rising. And let's not forget, we've got a big budget showdown coming up. We could have a government shutdown in the weeks ahead. So there's a lot of factors affecting the economy right now.
Steve, let me jump in.
Real wage growth since Biden came into office is down.
I've got the numbers. I want to start going through these, and then Charles is going to anchor the program. But so 216,000 is the actual number. This is the headline number for non-farm jobs. 216,000. Wow. So it is much stronger than expected. And the estimate was 170,000. Taking a look at the market, we are seeing a real escalation, guys, of selling. I got to point that out. Now, the unemployment rate did not tick up as expected. It came in at 3.7%. We were looking for 3.8%. But again, that non-farm number coming in much stronger than expected. Going down to average hourly earnings, year over year, that wage inflation story I was talking about, it jumped 4.1%, and that was higher than expected. And then also month to month, that wage inflation, average hourly earnings jumping 0.4%. That's higher than expected. The average was 0.3. Labor force participation rate, that came in at 62.5 labor force participation rate. The U6 number coming in at 7.1%. And then again, going down to some of these other jobs. I want to hit that government jobs number, guys. 52,000 on the government jobs. That is high. That is very high. Look at that, Charles.
Because, the market has not changed a lot since this number came out. Yeah, we're a little bit redder, but not much redder. And those two things you just mentioned jump out big time. Labor force. The labor force went down. What the hell is going on? That's why participation, this is a big move down. 62.5 from 62.8. That is absolutely huge. We went from 168 million workers to 167 million workers. That's a monster decline. Of course, you back out these 52,000, and what do you have here? You have 155, right? So that misses the number. This is what we're really talking about. The private sector is struggling, and, maybe they made up for it with wages, but one thing that we got to look at too, Cheryl, because it's not just wages, it's work week. If employers want to hold on to workers, and of course we know they're loath to lay them off and retrain new ones, they have been shortening the work week. That's been the secret sauce. That's been the thing that's hurt people. So it's awkward when they say, well, wages are now above inflation. Yeah, but pay isn't if I'm working fewer hours.
Average work week, Charles, came in line at 34.4. But again, I keep going back to that government job. That's exactly what I was talking about. Anyway, Steve Moore, jump in here. Your initial reaction to these numbers.
As I was just saying, the fastest growing sector of the economy over the last year has been, a combination of healthcare and government. And then you have university jobs, too. You throw in that. And those are also associated with government. I think we've had now for the last year or two, the government kind of carrying the economy on its shoulders. That cannot persist. I am happy to see that you're seeing slight wage gains. But come on. I mean, somebody's got to explain to me why people are leaving the workforce. I mean, we should be in a recovery. We should be seeing people joining the workforce. Yeah. That is bad news for the American economy.
Rebecca, I'm going to Charles, go ahead.
But I bet you just let me share some other things with the audience, because these are red flags. Transportation and warehouse down 22,000. The reason that was amazing is for a while people were able to leave leisure and hospitality jobs, low-paying jobs, and get a job at a local warehouse. These Amazon warehouses made a lot more money, a lot more benefits. This number is now negative 3 months in a row. Also, temp work. Temp work has been negative every single month. typically that's an indicator where the workforce is. They're laying off temp workers and they're not becoming permanent hires. So 2 additional red flags.
Rebecca, what are you seeing?
Me? Okay.
Yeah.
Well, I mean, this I think someone's going to be $10 million richer because the yields are going to go up. So that person made a good bet. I don't know if it was inside information or not. But, you know, this is going to put more pressure on Powell, right? Because now he is kind of backed himself into a corner. We've got 3 rate hikes coming. The market won 6. And yet the jobs data is still showing that, you know, it's showing that things are coming down, that we are going to expect it to come down. But it's just the market getting ahead of its skis again, and then you're going to have yields go up, and that's going to be problematic.
That's interesting. Lewis, what do you make of this?
Well, first of all, it's a Friday, and traders like to clean out their inventory on Fridays because, you know, we have things like attacks in the Red Sea and stuff going on. So yeah, we're going to have a rough opening, but earnings will be coming out. Earnings are going to be good for the next 3 quarters, easy year-over-year comparisons. So probably every stock for itself. And I have not seen analyst cuts yet. I've seen some analyst downgrades, but no cuts. So I think we'll be rescued by earnings in a couple weeks, and hopefully bond yields will settle back down because obviously they're up today, and that puts us in a bad mood.
One of the things that I did see kind of crossing here, and I want to take this to you, Becky, is with the jobs and the wages. You know, again, with this stronger jobs report, we're now seeing the bets that the Fed is going to give us rate cuts. That bet on the market side of it actually pared back a little bit. But it is that employment story, Becky. But jump in here because, again, do these numbers align with the types of jobs that you're seeing added?
Yeah, so first I would say retail was up 17,000. And so I'm going to pair something Charles said about logistics with retail. We definitely saw a click and brick holiday season. We started seeing logistics jobs spike in September, getting ready for an online buying cycle. Then December was carried by brick. We saw Walmart, Kroger come into the top employers. Affordable experiences was growing in terms of Wendy's, Pizza Hut coming up. Hospitality and leisure. And so as we look at 2024, you know, we see real-time data. So BLS is a month in arrears, but we see real-time data. We're seeing the economy fueled for jobs, Cheryl, to your question, in 3 areas. Jobs that help people. Registered nurses are still the #1 open job in our country. Jobs that transform businesses. Every company's an IT company now. Software developers are the #2 position in terms of open demands. I'm not talking government. I'm talking software. Could work for government, but we're seeing the top hires, given every company's a tech company, be Walmart, DoorDash for AI and machine learning. And then finally, in the #3 position is a little bit surprising, affordable experiences, as I mentioned, with Walmart and Kroger and people eating out, fast casual, Wendy's coming into the top 20, Pizza Hut. And then a surprising 4th that I didn't mention, which is jobs that support taking and collecting our taxes, as the Internal Revenue Service is the #2 hirer in the country as we sit here today.
Charles, weigh into that because these aren't quality jobs she's talking about. They're not high-paying jobs. That's a problem.
Yeah, it is. And the restaurant stuff has been somewhat of a, a miracle, sort of. You know, people are eating out. Now, part of that has been the fact that eating at home has been just as expensive. So why not? You don't have to wash the dishes. But by the same token, the sort of things, the sort of organic things that we want to see, and again, outside of these sectors, and I guess we've been hitting on it over and over again, the needle isn't moving, right? Well, you want to see manufacturing, you want to see construction. After all, they're pouring billions and billions of taxpayer dollars into these initiatives. At some point, we want to start to see it reflected in the data, and so far, we just haven't seen it.
Now, Julia, talk about the quality of jobs that are out there, and in particular, the salaries attached to those jobs.
Well, this is a hot report when it comes to wage growth, and it suggests that there's still plenty of wage growth pressure out there because the unemployment rate is so low. I mean, this is the 6th best year on record when it comes to low unemployment, better than every year other than the early 50s and late 60s. So employers are still struggling to recruit workers. Retention has improved, but recruiting is still very tricky.
And Rebecca, again, I want to point back our attention to Dow futures. We are seeing a little bit of an escalation in selling. You've got the Dow down 191 right now. We certainly did not begin the program in this territory. And a piece of this, I have to reiterate here, a piece of this is you are seeing those short-term bets on interest rate cuts actually pared back because you got a strong employment report. Right. It all goes back, when it comes to market action, Rebecca, it all goes back to what is the Fed going to do? And the big rally that we saw at the end of 23 based on the fact that Mr. Market is thinking he's getting six rate cuts in 2024. I don't know. I think that's a little bullish, but weigh in, Rebecca.
I think that when we were seeing, we saw not only, Cheryl, that it's paring back as far as getting all the cuts, but also the time frame. Like the March cut is getting more and more suspect, and the percentage is dropping as yields go up. So, it was always going to be skeptical to me for the Fed to raise or to cut rates in March, because Europe and UK won't get the CPI print until April, and I think they're going to cut first because I think their situation is worse, obviously. So it's going to put a lot of pressure on this Fed, and the equity markets are saying, oh, well, the yields are going to go up and companies are going to have higher cost of capital again. So this is going to pressurize margins more, and it's not going to, how are we going to duplicate 2023 in this environment? I just cannot see the headwind allowing the market to have another repeat year.
I'm old school, right? So when you say it's a strong jobs report, how can it be strong when 676,000 Americans dropped out of the labor force? When you say it's a strong jobs market, when there's 683,000 fewer Americans working in 1 month, 683,000 fewer, how can it be a strong jobs report? So this bothers me a lot. Right now, the needle's not moving a lot on the CME Fed watch. We're still looking at over 60% chance of a rate cut in March. But, I think Powell was hoping for something better than this. This actually, in some ways, he wanted to see participation go. I think that's one of the key things he's looking at. He wants folks to come in. Obviously, the more people that go looking for a job, the easier it is not to have, for employers not to raise wages. So if no one's looking for a job, an employer actually is backed into a point where they do have to pay the few people who are working. But as a society, how do we have 676,000 people leave the labor force right now?
Steve?
Let me add to that. I think, Charles, you're spot on again. And look, I said this last week last month when we had, we're missing about 4 or 5 million workers who should be working from the workforce. Well, now it's 4.5 to 5 million people who have kind of disappeared. This is one of those rare occasions when a lower unemployment rate is bad news. You know why it's bad news? Because what that lower unemployment rate is reflecting is fewer and fewer people looking for a job at the time when employers need workers. So that is a big problem. The other thing on wages that I find interesting, the federal government just announced yesterday that the average federal worker is going to get a 5.2% raise. That's more than private sector workers are getting. No wonder everybody wants to work in these cushy government jobs. I mean, they get huge benefits. They're getting a bigger pay raise than the private sector workers who pay their salaries. I find that to be somewhat annoying as well.
Lewis, that's a problem. That really is a big problem because these are taxpayer-funded jobs. These are not private sector jobs. And again, the issue is the types of jobs that they are: social services, government, health care. That's not sustainable.
That's right. And the fact that the workforce actually shrunk is very disturbing. I also should point out that I don't trust the January number we're going to get in a month. That's the biggest month for seasonal adjustments. Usually they have a big upward seasonal adjustment and just in time for the State of the Union speech. So we're not going to get another good payroll report till March, to early April, of course. And so we're going to be kind of flying blind here. And hopefully when we get the report on March payroll, it'll be a little bit better.
Yeah, no, and certainly.
Cheryl, what were the revisions for? I didn't hear what the revisions were for December.
I was just looking for them, actually, and I don't have them in front of me. But Charles, I do want to give you the last word here. I know you got to run because you've got more jobs to do today. But I want to give you your final word on just your take.
Just look at the corner of the screen, folks. Look at the corner of the screen. I mean, Wall Street is kind of looking at this, and again, always be careful of that initial reaction. We never really sold off the way. You're going to see two things. You're going to see headlines: a great, strong, amazing jobs report, yada yada yada. They won't break it down and say a huge chunk was government jobs, that private sector is in trouble. Yeah. They won't say that, but the stock market is kind of saying, okay, right now the stock market is giving Powell a pass. The Powell pivot, the Powell victory lap is not in jeopardy at this very second, looking at the initial reaction of the market to this jobs report. Well, even the yield, where they were over 4%, they're barely clinging to that. Wouldn't be surprised if the 10-year yield closes under 4%.
Well, and somebody may make or lose $10 million, which I think is so interesting. Lewis, I want you to jump in here. But real quick, guys, I want to just confirm, as I was getting finally a chance to get into the report here, and what the government is saying and where these jobs are: government, healthcare, social assistance. There are some jobs being added in construction. Julia, I'm going to take this to you. But transportation and warehousing, there was actually a decrease in jobs. Julia, is that in line with what you see, the data that you have?
Yes, so that sector grew so much during the pandemic that it is now sort of swinging back to normal. In fact, the normalization that we saw in 2023 was not quite as large as might have been expected, just based on the cyclical swing back, because structurally that sector is still very, very strong going forward because of the rise of e-commerce. So I expect that the declines there will continue for a few more months, but they won't be very large, and that industry will start growing again pretty soon.
All right. Becky, what about you? Do you see that as well?
Yeah, I'd say, the only surprise in this report is the fact that we saw participation go down. There is a positive side to that we want to talk about, which is employers are able to fill their jobs that are open faster. In fact, we've seen the time to fill a job, so by the time an employer wants someone to the time they get a talent, go from over 120 days down to 50 days. And in the highest skilled areas like software developers, it's only taking about 30 days to fill a job. So again, it's because there are fewer jobs posted and people seeking, but that is a positive for our employers. They're looking and enjoying that balance. The other concerning part about the report, as we talked about, is manufacturing. We do really need to keep an eye on manufacturing, and what the Fed takes action on interest rates. Of course, we'd like those to go down to stimulate goods production, to stimulate purchase. So manufacturing is one area to watch in the private sector.
Manufacturing was only 6,000 in this report. The estimate was 5,000, and manufacturing came in at 6,000. So to your point, it's not really a great number. And Lewis, that plays into productivity at U.S. corporations. And if we're going to see any growth, I mean, that's an earnings story. That's a profit story. And there is the labor component certainly is still a major issue for a lot of these companies who I just want to add, a lot of these companies shed jobs in 2023 because they were worried about the recession that never happened.
Yeah, manufacturing shed the most jobs. It's contracted for 14 months according to ISM. And so that's very disturbing. And so there is no... They build a semiconductor plant. They won't staff it till 2025. They can't find the workers. That's in Arizona. That's a TSM. And then, of course, all the big battery plants they were going to build in America have been postponed by the big three and due to lack of demand. So obviously, some of the onshoring isn't happening. And but the productivity enhancement will continue as we move more of our economy online and we continue to get more efficient. I would add that I do know that Amazon is starting to try to make some of the warehousing through independent contractors. Apparently, it's not efficient to deliver a tube of toothpaste to your house. So they're figuring that out. So
it's nice, though. It's nice.
Yeah, they're going to put that burden on independent factors. So that might be affecting the warehousing number too.
Interesting. Oh, that's a very good point there. Rebecca Walser.
You know, I was going to just pick up on his point about manufacturing. I mean, if you look at Germany, I know we're talking about U.S. jobs, but I follow Europe because obviously they kind of lead us. And Germany is basically almost in a manufacturing depression. And that is going to affect the entire, obviously, European theater and the U.K. So this is problematic that the organicness of the sectors and the different sectors that have the growth is job related, healthcare related, and retail, you know, and then we did lose so much labor force participation. Where are those people going? Are they going on to just, you know, Social Security and that's how they're going to live? How are these people? It's because the government stimulus program, Cheryl, from coronavirus have ended. So how are these people leaving the workforce? And when you have this happening, you have just a very anemic company or society. When I was looking at the Goldman's projections, they actually believe that in 2024, we're going to get monthly jobs growth at just 100,000, which is the break even, Cheryl, of the people that are leaving and the people retiring, the people that are coming. Mm-hmm. So they don't expect a lot of actual job growth this year. So I just, again, this whole thing, again, shows me that this economy is not the soft landing that everyone is portraying it to be.
Well, you know what, Steve? You know what this year is about? It's about an election, Steve. And this is an election year. And I want to get your take on that. Like, I'm not saying that Jerome Powell is political. I'm not saying that any moves by the Fed are going to play into the current administration's plans to try and get, you know, to keep the White House. But you tell me,